Unfortunately, there seems to be no end to our discussions about the reasonableness of compensation, particularly in cases involving closely held businesses. After all, in those cases, the person receiving the compensation typically controls the company. As a result, the employer and the employee are not dealing with each other on an arm's-length basis. In addition, viewers will recall that the IRS, in cases involving C corporations, views these situations as disguised or constructive dividends. The service's perspective is that individuals who are owners as well as employees would prefer to receive additional income from the corporation in the form of compensation, which is taxed at their personal rate rather than as dividends, which are subject to so-called double taxation. Traditionally, courts, including the tax court, tend to travel a middle road, preferring to examine 4 or 5 common law factors that typically determine the reasonableness of compensation. Of course, when these disputes reach the courts, which they frequently do, the decision has often been based on 1, the employee's position, hours, and duties; 2, what similar companies pay for similar services; 3, the company's financial condition; 4, the possibility of disguising dividends as salary; and 5, the internal consistency of compensation.
Joining us this month is Richard Shapiro, tax director at the firm of Eisner Amper. It's great to see you again, Richard.
Mike, good to see you.
Now, Richard, I'm curious, why does this issue of reasonable compensation come up so frequently in tax controversies?
Mike, reasonable compensation is a very factual issue. It's an easy issue for an agent to put his arms around. It doesn't really involve really heavy-duty technical tax provisions. Any reviewer is going to comprehend reasonable compensation or think he or she does. And so it's sort of low-hanging fruit for the IRS when it comes to examining taxpayers.
Tell me, is this issue high on the IRS's enforcement agenda? Is that why we see it contested and litigated so often?
Mike, I can't say whether it is high on the priority list. It's always there. Again, because it's an easy issue to address. And there's real money involved. There's real money involved as to whether or not money that is being paid is compensation, or is a distribution of earnings, or is a dividend, depending on the kind of entity we're looking at. So as a result, it's always going to come up. It's always going to come up in an audit process, particularly of companies that have significant earnings, or partnerships or S corporations that have significant dollars flowing into them and out of them to shareholders, partners, employees, as the case may be.
I suppose the starting point is Code Section 162, which says that you may, quote, deduct ordinary and necessary business expenses, including a reasonable allowance for salaries and other compensation for personal services actually rendered, end quote. It sounds as if the determination of reasonable compensation is, by definition, incredibly subjective, doesn't it?
Mike, absolutely. Reasonable compensation is probably one of the most subjective concepts in the entire Internal Revenue Code. One of the reasons why reasonable compensation is so litigated is because the stakes are so high to the IRS. For corporations, compensation is deductible to the corporation. On the other hand, a dividend paid by the corporation to shareholders is not. If you're able to sustain a payment as compensation, then the corporation has a deduction. On the other hand, if it were challenged and rather treated as a dividend, then the corporation doesn't get a deduction, which would have the impact, therefore, of raising the income of the corporation and therefore increase the amount of tax that the government is going to collect from corporate taxpayers.
Well, if you go back through the case law, there are certainly a number of so-called common law factors that courts typically use in analyzing the reasonableness of compensation. I suppose these can be used to justify and to attack any executive salary, can't they, Richard?
Mike, there are a number of factors that courts can look at and do look at. And all courts don't use the same list. Some use a short list, some can use as many as 20 different factors. They can cover such things as the nature of the activity that an employee is engaged in, the nature of the business of the employer, the scarcity of employees doing this particular kind of work. It can be the particular contributions that the employee makes to the corporation. There are a whole variety of things, and there's no right or wrong list. There's no particular weighting that is used. It's kind of, there's a whole litany of things that a particular court is going to look at, evaluate, and based on that compendium of items, come to some conclusion. There's no black and white answer to whether or not a particular situation is going to be viewed as reasonable or not under this common law approach.
Thank you, Richard. We'll return to your commentary in a minute.
Instead of relying on the so-called common law factors, some appellate courts have been moving toward a much simpler and more basic test, the independent investor test. Of course, many closely held businesses are owned by key executives and family members, and not by independent or disinterested shareholders. In these cases, the court assesses the situation from the perspective of an independent investor, even if it is a hypothetical one. Given the dividends paid and the return on equity enjoyed, would that independent investor approve of the compensation that is being paid to the employee in question? When we last discussed this area of controversy, we noted that two influential appeals courts, the Ninth Circuit in California and the Second Circuit in New York, had adopted the independent investor test as the lens through which other tests or criteria are viewed. For many disputes over reasonable compensation, the leading case occurred when the U.S. Court of Appeals for the Seventh Circuit adopted the independent investor test. In reversing a tax court decision involving the privately held Exacto Spring Corporation, well-known and respected Judge Posner held that the CEO of a closely held business did receive reasonable compensation after the lower court improperly used a multi-factor test.
In recent years, Richard, I heard that some courts were examining these controversies almost solely through the lens of a so-called hypothetical independent investor test. Does that change the focus somewhat?
Mike, it does change the focus a little bit. A number of courts are starting to use this other approach, namely thinking in terms of having an owner employ a manager to run a business and grow the company's assets. What kind of return, what kind of return can that manager obtain? And what does that convert to in terms of compensation level?
Well, let me ask you, to what extent can or should reasonable compensation for a CEO include so-called catch-up pay for startup years of low pay or no pay?
Mike, actually there is some case law. I believe one case is Choate Construction, I believe is the name of the case, in which they actually did take into account the early years of low or no earnings and factored that into the calculation of what reasonable compensation would be for a current year.
Now, on one hand, executive compensation in a C corporation is often considered by the IRS to be unreasonably high. On the other hand, the service has really brought the issue of underpayment of S corporation employee shareholders to the forefront in recent years. In those situations, the executive's compensation is considered to be unreasonably low, right?
Mike, it may seem a little odd that in certain circumstances the government is going to argue that compensation is too low, and in another situation they're going to look at compensation as unreasonably high. But when it comes to S corporations in particular, the question becomes often one of the application of payroll taxes. And the S corporation, by having the compensation higher, or rather by having the compensation lower, the goal would be to minimize the application of payroll taxes to those situations. And from the government's perspective, let's say, no, 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 the compensation should be higher, thereby being in a position to apply payroll taxes to the compensation that's to the higher level of compensation that's being paid.
Most viewers are aware that a corporation is an artificial person created by state law. Although the tax law often does not distinguish between types of corporations, Congress did become aware that some businesses, professional service corporations, were being used to shield income from their employee owners' higher tax rates. As a result, since 1987, the benefits of lower tax rates have been denied to personal service corporations, which pay tax at a flat rate of 35%. Of course, not every business that performs personal services is considered a PSC. First, their principal activity must be in the fields of health, law, engineering, architecture, accounting, actuarial science, the performing arts, or consulting. And second, substantially all of their stock must be owned by employees, former employees, or their estates. In a recent case, the tax court upheld an IRS-imposed tax deficiency determination as well as an accuracy-related penalty on a personal service corporation. In this case, Midwest Eye Center was not able to show that the $2 million deduction it claimed for bonus payments made to its sole executive and shareholder represented reasonable compensation for services rendered. As a result, the tax court agreed that the payments were disguised dividends and disallowed $1 million of the salary deduction, while also imposing more than $62,000 of accuracy-related penalties on the business.
Richard, let me ask you specifically about personal service corporations. Are PSCs such as Midwest Eye Center taxed like a C corporation, where we're concerned about unreasonably high compensation, or like an S corporation, where we're concerned with unreasonably low compensation? Or is a PSC really sui generis?
Mike, personal service corporations are a subset of corporations for tax purposes. They have certain of their own unique rules. For example, applying a standard 35% tax rate, but they're corporations. They're not some other type of tax entity.
Well, in Midwest Eye Center, the IRS disallowed $1 million of the $2 million bonus paid to its sole shareholder and medical director. How come? I mean, he was a surgeon who had to increase his workload significantly and unexpectedly.
Mike, that's true. Those were the facts. But there was no substantiation of the expenditures that were made. There was no real information provided in the audit context to properly justify certainly to the desire of the courts to justify the taking of these larger deductions. In addition, there wasn't any methodology or indication of how the taxpayer came upon the amount of the bonus that they claimed as a deduction as compensation.
Okay, the service is always looking for substantiation and for comparability. Knowing that, why would Midwest Eye and their tax advisors let something like this happen?
Well, Mike, in the end, they didn't want to subject that income to the 35% rate of tax on a personal service corporation. So by paying a larger bonus, they're bringing their taxable income significantly lower and therefore reduce the amount of tax and minimize the application of that 35% tax rate to the income of the business. Plus, as we get to the end of a tax year, businesses don't necessarily know exactly where they are in terms of the amount of income that they have. And so you automatically have to wait till you get relatively near year end in order to have a really good sense of what your income is. So you have to wait. You really don't have, practically, you really don't have any choice but to make some of these determinations really, really late in the year.
In this case, we're also talking about an accuracy-related penalty of more than $62,000. That certainly gets your attention, doesn't it?
Mike, it certainly does. Understand that with any tax controversy today, it's almost automatic that the service is going to attempt to impose penalties. We're not normally talking about interest anymore. Almost as a rule of thumb, the service automatically looks at penalties. And in this particular case, they were alleging that there was a significant underpayment of tax, which creates a penalty in and of itself. So, yes, a $62,000 amount is going to catch your attention without doubt, and materially increases the load. And I'd also say that the use of penalties by the service aggressively changes the playing field when taxpayers are trying to consider how aggressive or conservative they want to be in filing their tax returns. In the old days, if you were concerned with tax liability and interest, and you could understand what the value, the cost of interest is, that alone might indicate to a taxpayer that he, she, or it can be a little more rather than a little less aggressive. But once we start as a regular activity from the government alleging and aggressively alleging penalties of one kind or another, that does impact taxpayers and how they conduct themselves in the tax world.
If our viewers could take one thought away from this discussion on reasonable compensation, what would you like that to be?
I think, Mike, taxpayers have to understand that reasonable compensation is almost an automatic issue for the Treasury, for the IRS. As I said a little earlier, it's an easy issue for the IRS, for agents to put their arms around. It's not complicated. The answer may not be black and white. It is extremely subjective, but you don't have to be a rocket scientist to at least think about reasonable compensation as an issue. So my word of advice would be go into questions of reasonable compensation with your eyes open. Understand that aggressive positions, whether it's on the high side or the low side, depending on which kind of entity we're talking about, is likely to catch somebody's attention. So long as you, the taxpayer, understand that, go for it. But understand what you're doing, because the likelihood is it's not going to fall between the cracks. It's going to be looked at.
Over the past 2 years, we've heard several proposals to streamline the way that partnerships are audited by the IRS. First, there were proposed new rules for auditing partnerships with more than 100 partners from Dave Camp, then chair of the House Ways and Means Committee. At the same time, President Obama included similar changes for auditing partnerships as part of his administration's budget proposals. In both proposals, the purpose was the same: to respond to IRS difficulty in assessing the tax owed at the partnership level, particularly in cases involving complex and multi-tiered partnership arrangements. Just a month ago, in enacting the Bipartisan Budget Act of 2015, Congress repealed the current partnership audit rules and replaced them with a two-tier structure. The first, or lower tier, is for partnerships with 100 or fewer partners. These partnerships could elect out of the new rules and, similar to the current TEFRA rules, be audited under the general rules applicable to individual taxpayers. Unlike the current law, the onus will now be on the partnership to opt out of the rules rather than either automatically being excluded under TEFRA or being offered the opportunity to opt in. The election to opt out must be made on an annual basis, and it will only be available to those partnerships that do not have other partnerships or trusts as partners. Partnerships that do not opt out, along with all partnerships of more than 100 partners, will be subject to the new streamlined audit approach. Under the new rules, the IRS will examine the partnership's items of income, gain, loss, deduction, credit, and partners' distributive shares for the year under audit. And any adjustments will be assessed directly to the partnership rather than to the individual partners in the year that any audit adjustments are finalized. Although the partnership may shift the tax liability to the individual partners, it will then be up to the partnership, rather than the IRS, to issue adjusted information returns, such as amended Form K-1s. Of course, it's going to take time for partnerships and their tax advisors to adjust to the new rules. And in order to allow sufficient time for the IRS to issue implementing regulations, the effective date of the new provisions is delayed until returns filed for tax years beginning after December 31st, 2017. However, a partnership may elect to apply the new rules for earlier tax years beginning after the enactment date. In case you were wondering, the Congressional Budget Office, CBO, estimates that the new rules will raise approximately $9 billion in additional revenue over the next 10 years.
Now tell me, Richard, why did Congress change the rules on how partnerships are audited for tax purposes? Was there a great hue and cry?
Mike, there really wasn't a big hue and cry to change the rules. At the end, it really became a question of money. In connection with the passage of the 2015 budget, Congress needed some money. And the perception has been that there's money to be raised from changing the audit regime of partnerships, that money was being left on the table in terms of how partnerships get audited. So scoring some $10 billion off of changing partnership audits seemed a good way to pay for the budget bill. And so we got a budget bill that had partnership audit changes.
Well, that makes sense. But tell me, since partnerships are considered pass-through entities, doesn't it make sense that they would just be audited under the rules that are applicable to individual taxpayers?
Mike, that sounds right. But partnerships are much more complicated entities, requiring a different approach. And historically, the rules were developed actually going back to the early 1980s, where partnerships that had a number of partners, 10 or more. Partnerships with 10 or more partners had a different tax regime imposed on them in terms of audits, so-called TEFRA audit.
Well, for more than a decade, we've had separate audit rules for the so-called TEFRA uniform partnerships and for electing large partnerships. Now, how have those rules worked from your perspective?
Mike, I probably can't or shouldn't speak for other tax professionals, but from my perspective, I think that by and large, the TEFRA rules and the large partnership rules have been considered to be cumbersome, difficult to administer, that created many of the problems that they perhaps were supposed to solve. And so it was felt that the time had probably come to adjust those rules a bit, and that is why we now have some new rules that have been imposed through the Budget Act
Okay, let's turn to the new procedures. First of all, do they really apply to all partnerships?
Mike, technically they do. They apply to all partnerships unless a partnership elects to opt out of the application of the rules. Not all partnerships can opt out. Partnerships that have 100 or less partners, all of whom are individuals, S corporations, regular corporations, foreign corporations. If they were domestic, they would be corporations, estates of deceased partners, and partners of partnerships.
And I know there are lots of different types of entities that, for federal income tax purposes, are taxed as partnerships. Are all of them, whether they're LLCs or LLPs, going to be subject to these new audit procedures?
Mike, if they are taxed as partnerships, they are covered by the rules. Now, you mentioned LLCs. Obviously, an LLP is going to be treated, limited liability partnership is a partnership, legally and for tax purposes. LLCs, understand limited liability companies can be taxed as companies. So to the extent that they're taxed as companies, they're not going to be subject to the rules. But an LLC that is treated as a partnership is a partnership for tax purposes, and so therefore will be covered by these rules. Mike, master limited partnerships structurally are partnerships. But you're right, most of them are treated as corporations for tax purposes. And for those entities, these rules aren't going to apply. They're corporations for tax purposes. However, there is one small subset of MLPs that are taxed as partnerships, and they are generally in the mineral and natural resource areas.
Okay, so tell me, what difference does it make if the service is examining the partnership's items of income as opposed to examining individual partners?
Mike, if individuals are being examined, then only the individuals are going to be subject to the determination that the agent, that the service concludes as part of the audit. Whereas if the partnership, the entity, is the one that is being examined, then the impact of that audit is going to flow through to the underlying individuals. So therefore, it makes a very big difference. So you're looking at who is covered, you're looking at consistency. Big issues when it comes to the taxation, the review of partnerships from an audit perspective.
In a similar vein, Richard, what difference does it make when those adjustments are taken into account?
Mike, it makes a very big difference which year we're talking about. If we're talking about the year of the audit, the reviewed year, then the parties that are going to be affected are going to be the partners who were partners in the year of the audit, the audited year. On the other hand, if we're talking about making an adjustment relating to an audit year, but we're making it in the year of the review, a later period of time, what's going to happen is that you may impact partners who weren't even partners in the year of review, or at very least may have partners whose interests, percentage interests, are different. So whether we're making the adjustment in the original year, the audited year, or the audit adjustment year, the later period is going to make a huge difference.
Okay, let's make sure I understand you, Richard. How, at what rate, and at what time is the partnership going to be liable for these adjustments?
Yes, Mike, the partnership itself is going to be liable for the tax. It will be liable for the tax in the year of the adjustment. The tax rate that will be imposed will be the maximum tax rate under the individual tax rules and under the corporate rules, depending on who your partners are in the partnership as it's being audited.
As pass-through entities, partnerships are not usually liable for taxes, are they?
Mike, that's absolutely true, normally. But under the new rules, as a result of the Budget Act, partnerships themselves are going to be liable for the tax, unless, of course, there is the opt-out that we've previously discussed.
As a general rule, individual partners are jointly and severally liable for the debts of a partnership. Will that be true for the liabilities that are determined at the partnership level?
Mike, no, that will not be true. Under the new rule, if the partnership is the one liable for the tax, that is, there has not been an opt-out, then the partnership will be liable. Individuals will not be joint and severally liable. They will not be joint and severally liable under the new rules.
Speaking of individual partners, what happens if some partners voluntarily file amended returns for the year in review? Will they still face what the new statute calls an imputed underpayment?
Mike, that's a good question. If individuals file amended returns, the amount of liability relating to those individuals will be deducted from the amount of liability of the partnership. The liability of the partnership is referred to as a imputed underpayment. That's going to be reduced to the extent that individuals file amended returns. There won't be a double count, in other words.
You said that the imputed underpayment is at the highest tax rate. So what happens if one of those individual partners can demonstrate that he or she is in fact taxed at a rate that is lower than the maximum tax rate?
Mike, if the partnership can prove to the service that partners within the audited partnership are subject to tax rates that are less than the maximum individual or corporate rates or are tax exempts, then the imputed underpayment will be reduced for purposes of the audit adjustment.
You mentioned what happens if the partners voluntarily file amended returns, but what if the amended returns are adjusted forms K-1 filed by the partnership? Is that also an alternative to the imputed underpayment?
Mike, that is absolutely correct. Under the statute as written, there is an alternative to the mechanism that we've just been discussing, namely a partnership as a means of avoiding paying at the partnership level can issue these adjusted K-1s and then pushes down the obligation to pay the tax back to the individual partners.
I keep saying by the partnership, Richard. And tell me, are most partnerships still going to be designating a tax matters partner, or TMP, to act on behalf of the partnership?
Mike, I'm glad you asked that question. Under the new regime, there will no longer be a tax matters partner. That will go out with the end of the regime of the TEFRA partnership audits or the large electing partnership audits. We will now simply have a partnership representative, and different from existing law, that partnership representative doesn't even have to be a partner. That's a big change.
Let's say that you represent one partner, but you don't prepare the K-1 forms for the partnership. Can the individual partner or the tax preparer still file Form 8082, notifying the service of an inconsistent treatment with the partnership return?
Mike, that's a fair question to ask. Whether under the new regime we will be using that form is a question that I can't answer. Nobody can answer it at this point. What I can say, however, is that under the new regime, partnerships and their partners are required to use consistent positions. Inconsistent positions are not permitted unless there is notice to the IRS that there is, in fact, an inconsistent position being claimed.
So far, you've been reporting on and interpreting the statutory language from the Bipartisan Budget Act. At some point, the service will issue some more expansive regulations. What's the most important item that still needs to be addressed?
Mike, I think that probably the most important area for which some significant help is required will be the area of partnerships that are tiered. Tiered partnerships. What do we do when we have a partnership that's a partner in another partnership? What happens as you work up and down the chain? I don't know what the answer to that is. And I think particularly today where there are so many situations where partnerships have other partnerships as partners, that seems to me to be a significant problem that needs to be cleaned up.
Well, that makes sense. Are there other issues?
Mike, there are a lot of details that need to be filled out from the law. There are many areas of the law that in which the Congress says under regulations to be issued. So to that extent, normal kinds of housekeeping that's required would have to be done here as in any piece of legislation. I would say that, for example, what do you do with technical terminations? Technical terminations can happen, for example, when in a 12-month period there's a 50% or more change of ownership. How is this new law going to deal with those situations? How do they fit in? To me, anyway, it's not entirely clear. That would be one of the big things that strikes me that has to be done, in addition to the tiered partnerships, which we've already discussed.
Well, you probably know, Richard, that a lot of our viewers are corporate financial executives. As a result, they become very familiar with FIN 48, now codified as ASC 740-10. I suppose these procedures could also have an impact on tax accruals for book purposes, couldn't they?
Mike, that's absolutely true. And a lot of our clients have been asking that specific question because we're looking at situations where now partnerships themselves may be liable for tax. And so that immediately brings to mind the application of FIN 48. Exactly how this law would interact with FIN 48 is unclear, but it's certainly an issue of some significant concern and interest by many of our clients.
In a similar vein, there have been occasions when Congress has enacted statutory language for the Internal Revenue Code and then wanted a second bite of the apple. And besides guidance from the service, are there any so-called technical corrections to this law that Congress might already be considering?
Mike, technical corrections almost always follow the approval and enactment of legislation. It sort of comes with the territory. And I am sure that this is no exception. It should be pointed out that the effective date of this in general is 2 years forward, for years ending after December 31st, 2017. So there's a bit of time with which to work here. I would say that we are going to get a lot of input from interested parties on one aspect or another that they feel is of particular importance to them to tweak the law a little bit. It's a little hard to prognosticate at this point. We've got a lot of time. I think, however, that between now and the time that this legislation goes into force, there will be some tweaking, some technical corrections that will supplement whatever notices and regulations and revenue procedures that are likely to come down the pike. I think we're going to look at a whole package of ways of attacking this new legislation. Technical corrections, revenue procedures, maybe some revenue rulings, and notices, and regulations, of course. So that's what I see coming down the pike on this.
Eisner Amper's Richard Shapiro, thanks for bringing us up to date.
Thank you, Mike.